All right. This this presentation is really about it's about the gold sector, but it's about this investment clock and how we deal with it. And so this investment clock was put together by Lion One Selection and Investec, a big firm in London, about basically when you should be looking at stocks, when you should be buying them, and when you should be selling or shorting them. And so I'm going to run you through the different stages and get you to the point where I think we are. But none of this stuff is linear. And we have a lot of things happening here that probably don't make any sense or don't fit in this. So the first thing was the initial shock. So again, we're dealing with the gold sector. Okay, so this is the gold sector down here. If you can see this red dot about the capitulation when gold price was between $250 and $300 an ounce. This is when I went back to school for the third time, I think it was, in Colorado, Colorado School of Mines, and then I started working for Phelps Dodge here as a market analyst and a trader. And around here, when gold was about 400, I was buying puts on gold for Candelaria because it was a byproduct credit, and I came from a world of 200, 250 gold, saw 400, and I saw buy all the puts you can. And then our CEO went to the LME dinner with this guy named Pierre Lassonde. And at that time, Pierre Lassonde was saying that gold was going to go to 1,000. So we all had a bit of a chuckle. And then this happened. And then this is where I started working for Newmont around here. Our business plan prices back then started about 375, 400. We brought in Boddington, and we changed the business plan just to bring Boddington in, believe it or not, to about, I think it was like 425 or 450, just to get that project in. And then basically when I left, I think the business plan prices then were about 750. So during my time there, the business plan price went from 350 to 750 at Newmont, and that was only 3 to 4 years. But I remember during the global financial crisis how we dealt with that. Because when that happened, we went capital, like everything was cut. Nobody could do anything. You couldn't even buy a truck. And during this time, like that took about 3 months. And during that time, if people don't remember it, Freeport had doubled their dividend one quarter and cut it the next. That's how volatile that area was right then. And interestingly enough, we had a big equity portfolio then, and my job was to wean it out. And I ended up selling a lot of that stuff right before it happened, not knowing that this was going to happen. So no kudos to me on that one. But anyway, since then, during this cycle, we went up to about 550% in gold. But then we had the overhang. But before that, we spent about $195 billion on M&A. We wrote about $17 billion of that off and took about $164 billion off the market value as gold went down 43% to about 1060. And since that period, when gold price is low, that's what it looks like when it's not very volatile. When it's high, volatility looks a bit different, but still it was pretty much range bound. And the range bound was around this time, around 13 to 1350. But then we spiked. And we'll talk about that. So during that time, in terms of the initial shock, we basically took off about $130 billion, according to McKinsey, of enterprise value from these companies, from these gold companies. And most of that was related to commodity prices. So now we get into, okay, I've got hit with this gold price drop. Now what do I do about it? So this is now the reaction to the initial shock. So, and I'm not picking on Barrick, although I used to work for Newmont and it's fun to do. But it's just the data was very good. Kudos to Barrick for having really good data and easy to get. But Barrick's a good proxy what was happening to the majors. So you had a drop, and this is basically their cost structure. So most of the cost was the cost of sales of producing their gold, whatever it was, 6 million ounces, and the blue line here is G&A. Okay, and the thing about G&A is when I worked as an analyst, this G&A should not be discounted at 5%. It should almost be discounted at 0% because it never changes. So if you spend a lot of money, you should get hit hard by that. This was the exploration. Exploration retracted, and now it's coming back a bit. But the big deal is a 25% drop in costs. And amazingly enough, sometimes when you drop the costs, the production doesn't change, and you wonder why they needed all that cost in the first place. And so if we do it by the World Gold Council standard of using all-in sustaining costs, which is not a gap measure, we saw the same 25 to 30% drop in all-in sustaining costs, but now we're seeing a bit of a creep since about 2016. The most important part about cutting costs is making money. You don't cut off your nose to spite your face. So if you look at this was all the capital expenditures they were making. And, this is when the price peaked at about, 1960 or something like that. And you can see the red lines here are all capital costs. The black lines here are all operating cash flow. The net of both of them is the gray bar, which is free cash flow. And I'll talk about that more, but this is really where the industry on the majors are at, generating this gray bar, making money, which is a weird concept for a gold company. But that's the idea now. Why? Because their ability to get money has become more restricted. Okay, and now we talk about, okay, I've got these assets, the world has shrunk, my production profile has shrunk, no one's asking me to grow anymore, do I still need to hold these other assets? No. So $4 billion of divestments through this period. This is just Barrick. Okay? But now, going forward, with the Megamergers, which is another thing I'll talk about, we're going to see more divestments. So when you're looking at that junior developer and you're thinking about this thing's got to get bought out, remember there's going to be a plethora of other assets out there that are going to be put on the market. And these are going to be operating assets that are fully permitted. That's the competition. And so now we have the asset write-downs from all that capital you just spent. So one thing is this cutting dividends, and this is another thing that's important going forward. The free cash flow is not only for your new development projects, it's to sustain dividends. So we've had the big dividend cut, and when I worked for Newmont, dividends weren't a big deal. We were even questioning why we even do it, because we were a growth company. We went from 5 million or 4 million ounces to go to 7. But when you can't do that, you got to offer something else. The most important thing right now is stabilizing that. And then reducing long-term debt, because nobody's going to give you more money. So you actually have to make your own money and lower your debt. And some of that was about the divestments, using that money to pay down debt. So when people see the divestment, see the cash coming in, and you're wondering, oh, what are they going to do with that? They might buy a new company. No, they got to actually get this red bar down, because they still got way too much debt. So this is the debt. These are the write-downs. So we've had $25 to $30 billion of write-downs just for Barrick. Most of that, a lot of that was Pascua-Lama. And it's not only Barrick. So if you look at Newmont, okay, selling Midas, Nevada, Jundee, Western Australia, Penmont, Mexico, Wahi, New Zealand, PTNT, Batu Hijau in Indonesia, all that sold. And what was that to do? Reduce debt, reduce debt, reduce debt. And then going forward, dividend raised, dividend stabilized. Those are the themes. And then stabilizing prices. So this is year to date. So this is where we had the range bound 1300 to 1350. And then we had this spike here. And we'll talk about that. Low global real interest rates, trade tensions. A lot of this was trade tensions with the impact of a slower global growth rates, potential recessions. That's mine, actually. Can you just turn it off or throw it in the garbage? Yeah, sorry about that. I was supposed to finish by now, I guess. But this is the pullback. So if you really believe in the gold price going forward, this might be your opportunity. And so the negative yielding debt, $15 to $16 trillion of negative yielding debt. August, Germany raised its first negative yielding bond, 824 billion euro. And basically every year for those 30 years, you get $1 billion less. But importantly for the gold people, low interest rates environments is a good environment for gold. If you don't yield, which gold doesn't, theoretically, but bonds yield negative, that's a positive. Tariff uncertainty. And I keep changing the slide all the time because it keeps changing. And the truth is, who the hell knows? But the problem is that uncertainty is what's driving it. And so these are the partial agreements were sort of semi-agreed on by some officials, and then the U.S. president denied it 3 days later. That's what you're dealing with. But importantly, if you look at what the trade tariff uncertainty is doing, these are the GDP 2018 numbers for the top 19, 20 countries in the world. This is their average annualized I think this was Q2, growth rates, 1.6%, like relatively anemic. But the ones that are driving it, are the big economies, but mostly China. And the trade tensions are impacting these two, which are the biggest. And if these two go down, they're going to drag the whole global growth rate down. Yeah, so you could see that with the way where institutional money is going. You could see that in the gold ETFs. So in the gold ETFs, just this last quarter, the Gold Council put out that net inflows of 420 tons. Now that's a peak at about 2,900 tons in gold ETFs. But the gold price is now 1,500, where it was over that in the last period. And then the risk here really for gold is the net spec position. Because if anything happens on that thing is going to fall. Because right now it's as high as it was in 2016 when gold was $200 less. But if that goes down and you believe in the gold price going forward, those would be the opportunities to come back and buy more of the equities that you like. And so, still year to date, gold's not the best performer. Nickel because of stainless steel, but mostly because of the Indonesians, the Philippines, having restrictions on exporting nickel ore. And palladium because the gap between battery run cars and the emissions is going to be filled by the need for palladium on the catalytic converters. Okay, the recapitalization of the industry. So with all that happening behind you, is money coming back? So this is a historical 2009 to 2018. The number of private placements over 10 million. So these are now what we would term actually semi-significant private placements. But back in 2009, 2010, we were seeing well over 100 of these over $10 million placements every year. And, we were $14 billion of money raised here. And in 2018, almost the lowest, less than $2 billion. And I think it was only 38. I'm not sure why that value is there, but it was about 38 equity financing transactions then. This is all Canadian listed, sorry. So what's filling that gap is, like I showed you with Barrick and with most companies, when they cut exploration, what they did was what we did when I was at Newmont, but they did it more institutionally, that they proxied their exploration mostly grassroots, by investing in juniors. So it works for juniors because you can get it at a premium because they don't really care. I know I didn't. And they don't really need the warrants. They don't really care about that. And so that's a positive for the junior. But, you could see that this thing has grown about 3.5 times. And now, in 2017, they put about $1.4 billion into junior companies. So a lot of that gap in institutional retail that didn't go to juniors exploring came from majors. And the other thing is that in Canada, the speculative dollar or investor, the competition was with the cannabis sector or life sciences. So just recently this year, this is all year-to-date numbers. The blue is a cannabis sector ETF, but it peaked around March, and it's been falling as the results from these companies come out that they actually don't make any money. And then at this transition, when gold started going up, we saw more inflows into the gold sector. So here, you can see that. So over the last 6 months, I've documented about $1.5 billion of equity financing. This is Canadian. But you'll notice the average is only about 10 to 11 million. So on that other graphic that I showed you, anything below this line wouldn't even showed up in that graphic. But that's really most of the transactions. About 10 to 15% of the money was one guy, Eric Sprott, the biggest retail investor probably in the world in junior mining. So we see the recap of industry. And so what you want to see is that if you really believe in the metals, you think that, okay, now we should see more consolidation, as people think that if I consolidate, lower my costs, then I could take advantage of it by, buying better assets. So this is about the Megamergers. So this is the market capitalization of all the companies before the Megamergers, like a snapshot in late 2018. So what I'm trying to tell you here is the average market cap of these companies, big range, all North American listed, about $4 billion here, US. The idea here is that, and keep it in your head, the generalists that like gold don't like equity, mostly don't like individual equity. They prefer ETFs. Why? The same reason why they like ETFs for any kind of industry. They like the high liquidity, they like the anonymity, they like the trading flexibility. They could buy it, they could long it, they could short it, they could do anything they want. So ETFs have become the competition for big companies. It's not about Newmont versus Barrick. It's Newmont and Barrick versus the GDX. So, here's some time here. So the 26 major producers, cumulative market cap's $100 billion. At that time, that was $20 billion less than BHP, a big diversified miner. Apple lost $450 billion in 3 months. So our sector really doesn't matter that much to the generalists. It's small potatoes. And so that's what we're getting. Big fish eating the little fish, trying to get bigger in a smaller pond. And then we have private equity coming in. Private equity funding these companies, funding them with almost a 7-Eleven sort of distribution. I apologize for the 7-Eleven analog because you probably don't have 7-Eleven here, but I'm sure some of you get the idea. They'll do equity, they'll do debt, they'll do convertible debt, they'll do streams and royalties. But the overall cost of capital for this guy, just like 7-Eleven buying a loaf of bread, is going to be expensive. So the cost of capital here for everyone that uses 5% discount rates for development projects and producers is about 15%. And so cash takeover. So you want to see cash over paper because these guys should be thinking, oh, my paper's going to go up, so I'll use my cash because I'm making so much money because the commodity prices are going up. But what you'll see, it's not who you think it is. So we have seen cash takeovers, but it's been mostly the Australians coming into the North American market. Why? Because over the last 3 years, from last year, they've been making money because the local gold price, because of the weakness of the Australian dollar, has gone up to $2,200, $2,300. And they've been making a lot of money. Their equity is good. But in order to buy a North American listed company, they have to issue cash because nobody wants their paper. And so that's what you see. You see premiums, all cash bids. Santa Barbara bought Atlantic Gold. You got Newcrest buying Red Chris. That's $806 million here. That's $534 here. That's Northern Star coming out of Australia to buy the Alaskan asset. Pogo, $260 million. So that's where it's all coming. Taylor, that was a 50% premium on a no bid. Nobody else was buying that. But they came out of the blue, 50% bid, all cash. Why? Because they can. And the Australians weren't growing in Australasia. You know, all the Australian assets were getting too big, too expensive. So then there was no competition here because the North Americans weren't doing anything. And why? Here, you got Newcrest by itself, $3.5 billion of free cash flow generated from their second half of 14 to 19. Their fiscal 19. Okay, so here's a summary. Okay, so all those various indicators sort of suggest, you know, you've gone from looking and now might be a time to buy. We've had the post-shock, we had the cost cutting, we had the dividend restructuring, write-downs, divestments, gold, stabilizing every time it drops might be an opportunity. Recap of the industry, but that's only been juniors. Megamergers, producers funding juniors, and cash bids by Australians. And so this is an important part as well in terms of the makeup of who's investing in what. So back in 2011, and this was from Van Eck, basically, assets under management in North America, most of the U.S., $54 billion directed to gold. Okay, so that's a big pie. 94% of that was institutional equity, stock pickers. That would do your private placements, you know. But now the pie has shrunk. So that $54 billion is $30 billion. But now that 94% of active is now 33%. So overall, you've had a 80% drop in institutional money coming into the sector. So you're wondering why there's nobody meeting Toronto and you've got less people to talk to in New York. It's because they don't exist anymore. There were even redemptions in August. And 20%, a company pointed to me where their share price went down. And that was exactly because this company, this fund took a 20% redemption in August. Okay? I'm almost done. Okay, and so what's interesting, as I was going on about ETFs and how they prefer ETFs, overall, there's still been $2 billion taken out of ETFs. Why? Because they still prefer gold. So that's the GLD. It's flattening right now, but that's the GLD. That's the big pump. Here, they don't care. So this was everybody else leaving, and the generalists coming in. It's not for lack of money. It's this river's flowing in a different direction. And so, but I always got to give you guys a bit of hope. Another well-known conference in Beaver Creek, we saw a spike in the institutional category of investors coming to Beaver Creek last September. So hopefully that's a good sign. But I'll say anecdotally, what I saw in New York was more family offices, much like what you have in Europe. That's what's happening in New York. And when you do go to New York, those would be the people to meet. Anyway, various indicators, 5 to 6, recap, mostly junior, larger financings for mid-tier. We haven't seen that. So in March 2017, we saw Agnico Eagle raise about $220 million with one institutional equity investor, one fund. We don't see that now. So again, more inflows into gold ETFs and gold equity ETFs. All right. That's it. Thank you.